on the back of Fed Chair Powell's speech out in Jackson Hole. But our next guest says that stocks aren't going to add much value to investors' portfolios from here. Let's bring in Mark Okada of Sycamore Tree Capital Partners. Welcome back. It's good to see you.
Hey, Scott. How are you?
I'm good, thanks. So let's deal with the Fed Chair speech first. What do you make of it? And what do you make of the reaction here as we head towards the close in the stock market?
Well, I guess and digesting all the things he said, which wasn't much, there really wasn't anything new there. I guess the missed opportunity that I kind of see is that he could have been a little more hawkish than he was. We certainly have had a run of very strong economic numbers, which I think put this sort of no landing scenario on the table for everyone. I'm not in that scenario. I do believe in the lag scenario. We are still in the recession camp. And so, I think what he said was we're navigating by the stars under cloudy skies. That doesn't feel very comforting to me as far as, where we're going and how we get out of the situation of pretty persistent inflation. And so I think he's set it up that there certainly isn't rate cuts in the near-term future for anyone. We're basically going to be either here or higher. And I think that was the strong message that I heard. And from that standpoint, I think he's paying attention to what's happened to the 10-year in the last couple weeks. It's moved pretty hard.
Yeah, I mean, the 10-year's done some of the Fed Chair's work for him, perhaps. So
yes.
Why do you sound like you're in the half-empty camp rather than the half-full? You say inflation is, in your word, persistent. Others would say it's declining quite rapidly.
Well, I mean, he talked about the four contributors to PCE, and the part that's going sideways is half of it. So I think that in order to get that down, the lag effects of the move in rates, the massive move in rates they've already done, will take time. And so I think that's what's coming. The reality of that hasn't really happened. I think the banks are feeling it. The banks are saying, $1.3 trillion of CRE debt coming due in the next year, 18 months. They've got over $500 billion of mark-to-market losses in their securities portfolios. So I think as that trickles through the economy and slows things down, you're going to see this sort of no landing scenario kind of evaporate, I think, and we're going to have something that looks much more like a traditional cycle. And as far as like the outlook on stocks and how bearish I guess I sound per se, we're not super bearish on the equity market per se. We just don't see it as a relative value versus a lot of the other things you can invest in right now, especially in credit. I mean, we're having a great year. We're making good money in the credit portfolios, and we're not taking a ton of risk. We're making 7, 8, 9, 10% in the portfolios. And we like that. I'd rather own that than, I don't know, NVIDIA at whatever the stupid multiple is.
Well, I mean, you are kind of talking your book, but that's okay. You're a credit guy. I mean, I get it. You guys are a credit shop, right?
Yeah, exactly. But I mean, let's be like rational about it.
Okay.
AAA CLO debt. AAA. That means it is safer than the U.S. government. It's yielding 6.5%. What's wrong with that? I mean, I'm not selling anything to anybody. I'm just basically stating the facts about the relative value of things. Oh, and honestly, it's like when you think about what's happening within the Treasury market and the rates we're seeing, I think it's kind of hard to paint a picture where they go down anytime soon. So why not own some of that too? The fixed income feels like a much better place to be than equities, just in general.
Look, I totally hear you. It makes perfect sense, right? I mean, you've got to manage your risk, and you want to be able to sleep at night, and you can, forego some of the volatility in the equity market to know that maybe you'll return a little bit less, but you'll feel a lot better, and you'll still have decent returns, whether it's in certain parts of the credit universe or in cash. I totally get that.